You all know about Pratik Oswal. He's been a stalwart. He has a deep experience in index investing globally, and now he's bringing that expertise in India. He's totally focused on building this space of passive investing and and articulating why it is very important aspect of the investor's portfolio and how distributors today should position it with their investors. So, Pratik, to start with, Nifty 50 has been the basic index to go to over the past 5-6 years. Are we now ready to look beyond Nifty 50 and why?
Good morning, everyone. I think very excited to be here. Thank you, Cafe Mutual, and look forward to this panel. It's a very good question. When I first, my first, Cafe Mutual, conclave, the passive one, the question was why you should buy passive funds. And it's very good, very, good to hear that now that, Nifty 50 is an option, what else can we do, So I think the evolution is very obvious, and, as we believe at Motilal as well that, obviously passives is just not Nifty 50 or Sensex. In fact, I think when I first started working, for the Indian AMC industry about 6 years back, the only option we had was Nifty and Sensex. And, when I was, working in the US, before this, I had access to a lot of client portfolios, about 800 of them. And I saw that, the portfolios had active funds, passive funds, quant funds, factor funds, international funds, commodity funds, thematic funds. So the idea, behind actually, putting a lot of focus in index funds, ETFs, 6 years back was to broaden the horizon of investors, of why passive should be beyond just Nifty 50. But still, I think, Nifty 50 is still the most important index today. We at Motilal believe actually that Nifty 50 has done incredibly well in the last 15-20 years. But what is the meaning of passive? The meaning of passive is buying the market. If you don't know what to buy, you buy the market. That is the definition of what index investing is. When you're buying the S&P 500 in the US, you're actually buying the market. You're buying about 80% of the market, which is primarily the market. Unfortunately, India has grown so much today that the Nifty 50, if you just look at the numbers, may not represent the market today. Nifty 50 was formed in the 1990s, where India had a very few number of large cap companies, and the market depth was not there, and even the breadth wasn't there actually. But today, what has happened is that the market has really expanded in a very big way. Today, the Nifty 50 in India captures about maybe 45% of the India's market cap, and even in that, the top 10 companies will be about, say, 50-60% of your portfolio. So it's fairly concentrated. The third is that they're very slow moving. If you look at index investing, obviously you want to buy the market, but you are looking at buying companies that are fairly slow moving, may not grow as fast as what you would see in, say, mid and small caps. So we believe as as someone who's built index fund business, where we today manage about 65-70 funds, that investors should look beyond Nifty 50. I think, and that's the crux of it. Nifty, you'll have, we have metrics that say that, you will get better returns at a lower risk, and also lower concentration when it comes to, funds that are beyond Nifty 50. And more important, you're actually, buying the market. Something as simple as a Nifty 500 or a, Nifty 100 may capture the market in a much better way than a Nifty 50 can. So that's the idea behind why we are looking at investors to look beyond Nifty 50.
I think it's a very good point. People are blindly, if you go to investors, they look at only Nifty 50 as the barometer, as the benchmark, and they want to just put money in Nifty 50 being low cost, being representative of the whole market, which, as Pratik said, is a misnomer. So Pratik, if Nifty 50 is so narrow, what would be a right representation of the index to look at, to be looking at index investing?
Yeah. So, obviously, if you go by the definition of buying the market, that something broad, like a Nifty 500 would be a much better indicator than buying the Nifty 50 or a BSE 1000 or even a Nifty 100. If you just want to buy large caps, that itself is a very good definition. What's really important, and this is something that people don't talk about today, is, the definition of what construes a large, mid and small may not be the best definition in India. When people say large caps, by definition, that means the top 100 companies in India. When people say mid caps, it's 101 to 250, and small caps is 250 and beyond. Now, what has happened in India in the last, say, 6 to 7 years' time is that an average small cap company, 2019-20, when we launched a small cap index fund, was about 4-5,000 crore market cap. Today, an average small cap company can go beyond 25-30,000 crore market cap. So the risk of small cap investing may not be as high as what small cap investing was 6 years back. So, I think people should not associate the same risk as they did 10 years back to small cap investing. In fact, we would probably say that, in fact, you should probably invest more in small and mid caps because not only are you getting a profile of companies that are growing at a much faster rate, but actually they are less risky than they were because of the size advantage. So which is why we believe that when you're looking beyond Nifty 50, you are actually accessing a whole group of companies that are growing at a much faster rate, that are much bigger. Yesterday's small caps are today's mid caps. Today, like most large cap companies are beyond 1 lakh crore. I'm not saying that they won't do well. They do extremely well. But it's just that because of the size that they have, growing, in Infosys at say 25-30% is very difficult than say a mid cap IT or a small cap IT company. So it's just that, we believe that, growing broader makes sense from a return perspective, from a risk perspective, and from a longevity perspective.
So has 500 given better returns than 50 over a period of time?
Yeah. So in terms of returns, obviously, it has delivered higher returns. So, we tell investors that you should expect at least, say, between 1 to 2%, depending on where you invest, of outperformance when you're looking at Nifty 500. In fact, what's really interesting is, Kaushik, if you look at, I was telling someone outside, passives tend to be centered around Nifty and Sensex. But there's no AMC that has launched as many funds as we have, which may or may not be a good thing. But most of our funds have actually beaten the Nifty 50. So actually the criteria of us launching new funds is that, how do we launch a fund where we believe in 5 years' time, it should beat the Nifty 50 by say 1 or 2%. So I think something as simple as the Nifty 500, has demonstrated, maybe around 2% outperformance over maybe 1.5% over last 15-20 years. More importantly, it's less concentrated. There's more industries. There's more sectors. So in fact, people don't talk about risk, but actually it's less risky than the Nifty 50 also. So again, that's the statistic. The point being is that you're philosophically true to the word passive or the philosophy of passive, which is buying the market. And that comes in a much easier and simpler way when you're going broad or when you're going beyond, say, a Nifty 50.
So before I come to how active management works vis-a-vis passive, how does mid and small cap look in the passive space compared to the active funds? The indexes of 150 and 250.
So, looking beyond doesn't have to be just looking broad, but also, investors could look at investing in passives. You have small cap passives, mid cap passives. And the idea there is, to do with the philosophy of passive, but also simplicity. Today there are a lot of mid cap funds out there. There are a lot of small cap funds out there. And for someone to be able to choose and pick and choose the right one, obviously, most are pretty good options. But if you had to choose one, I think, index investing makes life very simple. That's one. Second is that, we've seen, now this is more looking at numbers, that the alpha generating capabilities, we've seen in passives that the large caps is one space where passives are now ruling. In fact, last 2 to 3 years time, in the large cap space, more money is coming to passives than actives. So in the large cap domain, we have seen that passives are now sort of doing very well. There, the ability to generate alpha is fairly limited. So there, passives have been preferred by a lot of investors. That is now slowly also happening in mid caps. if you look at mid caps in the last, say, 5 to 10 years time, even there, it has become, relatively difficult compared to how it was. I'm not saying that it's a better or worse option. This is just what the data shows. So from the perspective of simplicity, we believe that mid and small caps can also offer very simple, low cost, easy thing for anyone to do. The third thing, and this is again also something which investors should keep in mind, that today most large mid and small cap, say, actively managed funds are not 100% mid caps or 100% small caps. There is an element of mid cap fund will have some large cap stocks, will have some small cap stocks. So there is a flexibility, which is a good thing, that's been offered to a lot of funds for liquidity purposes. Say you are a 50,000 crore small cap fund, it makes sense to keep about, say, 20-25% in large caps in case there's redemptions or withdrawals. So if you're looking for something which is very true, for example, in a bear market, the active funds will do extremely well because of the large cap allocation, and the opposite might be true in a bull market. So just that to keep in mind, so true to label happens in a very big way when it comes to at least mid and small caps, within passive funds.
So, over a 30-year journey of mutual fund distribution of mine, I have always had major challenges of selecting the right fund, the right performing fund, and the top quartile. And I have made a lot of errors of trying to select the top quartile, which only becomes bottom quartile after 3 to 4 years. So in the last 5 years, since the smart beta products have started coming out, we have had intense look at these factors at play on the smart beta side, and we also compared with the US markets to see how these factors are doing vis-a-vis the index and active funds. So I personally am a very strong believer in smart beta investing, but Pratik, I'd like to hear from you about what smart beta is, what the factors are, and which factor is more prevalent. Today, when I see the data in the market, 50,000 crore is in a passive fund, in smart beta funds, of which momentum is the majority of the money is momentum factor. So, what's your take on smart beta and momentum and factor investing?
Yeah. As we know, so I'll talk about what smart beta is. It's a very if you look at index investing versus active investing, active investing, obviously you want to buy strategies that will deliver alpha. Passive funds will give you the cost, convenience, and the simplicity of just replicating the benchmark. Smart beta funds sort of come in the middle, where you have the transparency in costs of an index fund, but the outperformance of an actively managed fund. That's the promise. And so far, from inception, it has delivered on that promise. Most of these smart beta funds have delivered, higher returns than your broad-based benchmarks. So that is the in between, and which is why smart beta or factors as a category is very large. In fact, if you look at the US market, the largest segment in the mutual fund industry is index investing, your NASDAQ, S&P 500. The second largest is smart beta, and third is active investing. So that's how big this space is in the US. India also, smart beta funds. I remember when we launched some 8 smart beta funds 3 years or 4 years back, the market was only about almost 3 to 4,000 crore in market cap. Not market cap, AUM. Today you're looking at close to 50-60,000 crore. So almost 10 to 12 times growth just in the last 4 years, which is quite staggering. The issue with smart beta is that, we all know in investing that behavior is the most important. Investing is 90% behavior, 10% process. In fact, the best behavior is to not have behaviors, to just leave your investments. It's smart beta, this behavior becomes even more important. So I think the behavior smart beta is not 90, maybe 95%, and 5% is more process or selection. So we believe that, smart beta, tends to be very cyclical in performance. What that means is that unlike our expectations as investors is that when we buy a fund, it has to outperform the index at all points in time. Unfortunately, there's no strategy in the world that has done that consistently. you always have ups and downs, cyclicality in performance, and that's what drives bad behavior from investors, which is what leads to poor returns. In smart beta, it's exactly the same. You have momentum, which is a strategy. You have low vol as a strategy. You have value. You have quality. You have growth. So you have these multiple, and you have dividend also. So globally, there are many smart beta strategies. In India, you have these four. There'll be more coming in hopefully over the next few years. But just like most of the actively managed funds or most strategies, there is a element of cyclicality that comes into factors. So our view when it comes to factor investing is to give it at least 5 years, for it to demonstrate performance. And because what happens in a lot of cases is people tend to buy things that are trending. So for example, momentum tends to be the most cyclical out of the lot. It tends to go from extreme alpha to extreme negative alpha, and then it comes back. So people tend to buy it when there's extreme alpha, and then they have sort of a negative period. So I think that's fine. That's not a problem. It's just that you have to understand it, and you have to give those 3, 4, 5 years for it to actually come back and outperform. So that's our view on factors. Momentum is one factor which has delivered the most performance. At least outsized alpha tends to be the highest. But obviously, and that is what's led to as most of the AUM going there. However, all factors are, you have to be, all factors are good strategies as long as you understand the risk return characteristics. Just the last thing about factors, and this is very interesting, is, we believe that the next maybe 10 years, could be a very golden age for factor investing. Why would I say that? It's because, today the category is only 50,000-60,000 crore. Maybe a lakh crore plus if you're looking at AIF, PMSs also, because a lot of people have incorporated factors in their investing. But once this category becomes, say, 6 lakh crore, 7 lakh crore, 10 lakh crore, which will happen over the next, say, 10 to 15 years time, or hopefully before, then the alpha will also shrink considerably. Like in the US, for example, there is not a lot of alpha in factors. There is there, but it's very small, almost negligible. So I feel like, till this, sort of this entire space blows up, or if it happens over the next 10 years time, till it blows up, I think you would see good results coming in from this sort of investing. So we are believers that, this could be a good period until the space becomes very large and the trade gets very crowded.
So as Prem did say, 18% of the equity AUM only is in index fund, passive funds compared to 50%. So as you said, you're hopeful that this will continue to grow and expand. How Nifty expanded from 21 to 25. There's a 75% CAGR I was seeing in the Nifty index fund. So that is how it has grown. That's the same thing. I think that's what you're talking about. And how should distributors position the smart beta fund vis-a-vis the active fund in terms of alpha, the investor behavior, who always chasing returns, who don't have that patience to hold on for 2 years, 3 years, 5 years? What is your message to them?
Yeah, the messaging has been pretty standard. I think if you look at the number of, so we looked at growth in AUM, which is about 70-80%. The growth in the number of customers has been 100% plus, 100% plus CAGR since COVID. That's a very staggering CAGR number. You're looking at about 8-9 lakh investors to almost 1.5 crore to 2 crore investors just in the last 6 years. So that itself, it's a staggering number, and this is all published by Amphi. So you're looking at a very good adoption when it comes to index funds and ETFs. The awareness for index funds, ETFs have grown dramatically. We are not saying you should choose active over passive or passive over active. We are big believers of active, of alpha. India is an alpha making country and all of that. But I think in terms of allocation, we would at least, what a lot of the partners that we work with do is they have an allocation towards active and an allocation towards passive. So maybe, depending on whatever your customer profile and preferences are, we would recommend at least 20, 30, 40% can be passive. Maybe the balance can be active. So I think the combination is what works very well. When I used to manage money for investors in the US, there used to be, even though out there passives have been around for 50 years, half a century, the S&P 500 dates back to 1920s. So almost 100 years. So there, an average portfolio is about 50 active, 50 passive. The idea is that, you should have an allocation. That's the right strategy to have in client's portfolio. a lot of clients, at least a large cap portion, we see, at least from our conversations, tends to be in maybe part active, part passive. A lot of investors, when they're looking at the global allocation, can look at passives. Obviously, commodities has become a very hot thing now. So their passives have played a very large role in, making it easier for investors to buy and sell gold and silver. So there are pockets where, passives, and also there is thematic funds, where passives can play a large role because, it can be very specific. If you just want to invest in this sector or this theme, then, index funds can make that possible. So there are a lot of ways in which, you can have passives in the portfolio. It doesn't have to be just a Nifty or a Sensex. So that's and we believe that, we don't think that involvement is still less. It's actually grown significantly. If you look at the participation of only in, say, MOMC, we have thousands and thousands of our partners who are, distributing index funds and not ETFs, mostly index funds. So we have seen incredible traction. We were the first AMC to focus on the distribution as a channel. It used to be an institutional product about 6 years back. Now it's a combination of everything. So we are big believers, and we believe that the majority of the distribution for passives will actually happen through our partners.
So great. So I think I must thank the mutual fund AMCs in the industry for doing such a phenomenal work on explaining distributors like us about factor investing, about what their experiences have been, how they're working so closely with NSE to create all these factors, indices, and generate so much of data and be able to come to us with value-added suggestions. I personally run a multi-family office targeting large families. I've been able to make significant breakthroughs with families, with new cash, with new acquisition, just by positioning factor investing. I haven't looked at costs, I haven't looked at brokerages. That is subsequent. Our objective is first to win the trust, get the assets under management, deliver. And I've had these last 2 years have been a very challenging period because of the Nifty being very flat. Momentum has given negative returns, value has given negative returns, quality has done well, or rather value has done well over quality. So there will be a lot of plays, but you have to have that patience and that conviction in the value investing and in what you've selected, and be able to persevere with the client to not redeem and not look at something else. So it's been a challenge, but it's been a great journey. And I think it's very important for us to appreciate what the AMC industry is doing. And we should really work together hand in hand to build a portfolio of satellite and core around active and passive. That's the way to go. That's even your distribution commission costs will all active funds are going down. Today, a fund like Pratik will have 1.4 lakh crore. How much is the brokerage they'll give you? They'll give you similar brokerage of what you get in passive and all you know. So my suggestion is, don't go for cost, don't go for brokerages, look at clients, look at the behavior, look at asset allocation, and be long term. So thank you, Pratik, for a wonderful insight, and I wish you all the best for the day.
Thank you, Kaushik. Thank you, everyone.